Imagine this: a samurai sword forged in the fires of ancient tradition, suddenly unsheathed in the dead of night, silent, deadly, slicing through the air with precision that leaves no room for escape. That's the Bank of Japan right now, my friend, poised to strike at the heart of the global markets. And Bitcoin? It's the unsuspecting warrior in the crosshairs facing a potential 30% bloodbath. You've seen the charts flickering red, the whispers on X about a Japan move that's got everyone on edge. But what if I told you this isn't random chaos? It's a calculated ambush, hidden in plain sight, building for months. A megatrend that's been coiling like a spring under the ocean floor, ready to unleash a tsunami on crypto. You, the retail trader grinding through the volatility, need to know what's coming. Because if you're not prepared, this could wipe out gains faster than a black hole sucking in stars. But stick with me. I'm peeling back the layers forensic style to arm you for the fight. This is part one of our investigation: the strange shadows over Bitcoin. Part one: the eerie calm before the storm. Picture Bitcoin in late November 2025. It's hovering around $97,000, teasing that 100K milestone like a mirage in the desert. Retail folks like you are buzzing. ETFs are flowing. Trump's in office talking crypto-friendly policies, and the halvings echo is still pumping liquidity vibes. But then, out of nowhere, the price starts twitching. Not a full plunge yet, but these weird dips. 97K to 86K in days. Liquidations spike, $646 million gone in hours. It's like the market's got a phantom itch, scratching itself bloody without a clear culprit. You check the news. No major hacks, no regulatory bombshells from the SEC, just quiet unease. Skeptics say it's just profit-taking after the run-up. Overheated market, they shrug. But you know better. You've felt this before, the subtle tremors before an earthquake. And if you zoom out, the forensic evidence screams, this isn't retail fatigue, it's hidden pressure building from across the Pacific. Let's dig in, like detectives sifting through crime scene dust. First clue: Bitcoin's correlation with the Japanese yen. Over the past year, they've been dancing in lockstep. When the yen weakens, BTC pumps. When it strengthens, crypto bleeds. Why? Enter the yen carry trade, that shadowy beast lurking in global finance. Imagine borrowing money for free in Japan, rates near zero for decades, and flipping it into high-octane assets like Bitcoin. Trillions sloshing around, inflating everything from stocks to crypto. But lately, Japanese bond yields are creeping up. The 10-year hit 1.87% on December 1st, highest since 2008. That's not noise, that's a signal flare. Data from Reuters shows yen carry positions estimated at $3.4 trillion conservatively, but whispers in trading circles peg it closer to $20 trillion. And when yields rise, borrowing gets expensive. Traders unwind, sell-offs cascade. But here's the smoking gun. Historical precedents baked into the charts. March 2024, BOJ hikes 10 basis points. Bitcoin dips 23%. July 2024, 25 BPS up. BTC craters nearly 30%. January 2025, another hike, 31% wipeout. Each time it's the same playbook. Yen strengthens post-hike. Carry trades reverse like a vacuum sucking air from a room. And leveraged positions in risk assets like Bitcoin get torched. Polymarket's betting 98% on a December 19th hike to 0.75%. And Bitcoin? It's already front-running the pain, down 30% from October highs around 126K. You think that's coincidence? Nah. It's forensic proof of accumulation, not of coins, but of selling pressure. Hidden sellers, disguised as macro forces, stacking their exits while retail holds the bag. The most common objection I get? But Bitcoin's decoupled from traditional finance now, ETFs, institutions, it's digital gold. Come on, that's wishful thinking. Look at the data. BTC's correlation with Nasdaq hit 46% last month. It's a risk asset, pure and simple, thriving on cheap money. When Japan tightens the spigot, it's like pulling the plug on a bathtub full of liquidity. Crypto drains first, and you, staring at your portfolio, feel the chill. But this is just the setup. The real thriller? Who's pulling the strings, and why now? If this hidden mechanism detonates, it could drag Bitcoin below 70K. Stick around for part 2. We're unmasking the culprits. Part 2. The hidden architects of the crash. If you've been following this investigation, you know the strange price action in Bitcoin isn't random. It's the shadow of a massive force building offshore. That eerie dip from 97K, the liquidations piling up like wreckage after a storm, it's all pointing to Japan. But now let's pull back the curtain. Who is this hidden player, this samurai whale orchestrating what could be a 30% Bitcoin crash? And why are they moving now, in the dead of winter 2025? This isn't some rogue trader. It's the Bank of Japan itself, wielding monetary policy like a katana in a crowded market. A mega trend of global tightening that's been simmering since the end of zero-rate paradise. You, the everyday investor dodging these bullets, deserve the truth, because understanding the who and why could mean the difference between panic selling and positioning for the rebound. Let's connect the dots, thriller style. The BOJ has been the world's liquidity lifeline for 30 years, near zero rates, quantitative easing on steroids. Think of it as a massive reservoir, flooding cheap yen into global veins. Investors borrow it dirt cheap, convert to dollars, and plow into yield chasers. U.S. Treasuries, Japan holds 1.1T worth, stocks, and yes, Bitcoin. It's the yen carry trade, a black hole of leverage sucking in capital and spitting out bubbles. But why the shift? Inflation's biting Japan hard. Core CPI up 2.7% year over year per BOJ data. The yen's at 10-month lows against the dollar, eroding purchasing power like acid on steel. Prime Minister Takaichi Sanai's pushing for normalization to combat it, even if it means tolerating market pain. Anonymous sources in the Japan Times confirm a 25 BPS hike to 0.75% is locked in for December 19th, the first since January. Skeptics pipe up, but the Fed's cutting rates. Why would Japan's move matter? Easy analogy. Imagine the global economy as a war zone. The Fed's air support dropping liquidity bombs. But Japan, they're the supply lines, the hidden artery feeding the front. When they constrict, troops, traders, retreat fast. Historical data backs it. Post-2022 hikes, Bitcoin tanked each time because carry trades unwound. Traders repay yen loans by selling assets. In July 2024 alone, a hike triggered 600B crypto wipeout, 1.14B liquidations. Now, with US rates falling and Japan's rising, the yield gap collapses like a house of cards. Models from Deutsche Bank suggest 500B could repatriate to Japan in 18 months, spiking US borrowing costs indirectly. It's a macro crisis disguised as opportunity. Net zero goals, AI energy demands, supply chain shifts all need stable currencies, but Japan's move accelerates the chaos. And the who? Not just the BOJ, it's institutional carry traders, hedge funds, even Japanese pension funds like GPIF, 1.6T AUM repositioning. They're the hidden sellers, accumulating exit liquidity while retail chases highs. Connect it to big trends. AI boom requires cheap capital, but tightening squeezes it out. Energy transitions? Forget it if liquidity dries up. This is zero-sum global finance, where Japan's strength is crypto's weakness. But the real damage? It's not just Bitcoin. It's the ripple effects. Who gets crowded out? Who loses big? If this hike lands, it's a bloodbath for the little guy. Hang tight for Part 3. The collateral carnage. Part 3. The zero-sum slaughter. Who bleeds when Japan strikes? If you just watched Parts 1 and 2, you're locked in. The strange Bitcoin dips, the forensic ties to yen yields, the BOJ as the samurai whale hiking rates to combat inflation and yen weakness. It's all building to December 19th, a potential 30% crash trigger via carry trade unwind. But now, let's zoom in on the fallout. This isn't abstract macro mumbo-jumbo. It's a war zone where winners feast on losers' remains. Collateral damage everywhere, crowding out the weak, zero-sum effects ripping through portfolios. You, the retail viewer grinding your 9 to 5 while DCAing into BTC, you're on the front lines. Who loses when this Japan move hits? And how does it connect to the mega trends reshaping our world? This part uncovers the victims, the hidden traps, and why this could be your wake-up call. First, the obvious casualties. Leveraged traders. Picture them as soldiers in foxholes, overextended with borrowed ammo. When the BOJ hikes, yen strengthens like a concrete floor slamming up. Carry trades become unprofitable overnight. Data from BN Crypto shows past hikes sparked 20–30% BTC drops, liquidating billions. In October 2025, 19B vanished in 24 hours. December could dwarf it. Hedge funds and institutions unwind first, selling BTC to cover yen debts. Retail? You get the cascade. Margin calls like dominoes in a hurricane. Miners suffer too. If BTC hits 70K, profitability craters below costs for many, per coin metrics. Hash rate drops, network security wobbles. And ETFs? BlackRock's IBIT saw 234B outflows in November. Imagine the exodus post-hike. But counter the objection. Institutions are in now. Bitcoin's too big to fail. Wrong. It's crowding out the small players. Big fish like Japanese funds repatriate capital home, starving risk assets. Connect to real-world trends. AI's energy hunger demands stable grids, but tightening liquidity spikes borrowing costs for tech giants. Supply chains? Fragile as ever post-COVID, and a stronger yen disrupts exports. Net zero? Green energy projects need cheap capital. Japan's move is like a vacuum, sucking it away. Who loses? Emerging markets first. Countries like El Salvador, betting big on BTC reserves, face balance sheet hits. Retail investors in Asia, leveraged on cheap yen, get zero-summed out. It's winners, yen holders, versus losers, risk chasers, with crypto as the battlefield. The deeper pain. Psychological. You hold through dips, but this feels different, like an iceberg order, only the tip visible. Objections like, but Trump's pro-crypto, miss the point. Macro trumps policy, Fed cuts help, but Japan's the wild card. This hike could force deleveraging across sectors, healthcare to transportation, as capital flees to safety. Who wins? Bondholders, yen savers. But for you? It's survival mode. Yet, this carnage sets the stage for rebirth. What happens when the dust settles? Targets, stop runs, the vacuum suck-up. If you're still with me, Part 4 delivers the breakout or breakdown blueprint. Don't miss it. Part 4. The vacuum descent. Targets, stops, and holding through hell. If you've been tracking this serialized thriller from the start, the eerie Bitcoin price twitches, the BOJ's hidden rate hike blade, the collateral wipeout on leveraged players and emerging dreams, welcome to the finale. This Japan move isn't just a blip, it's the detonation of a megatrend, unwinding 30 years of cheap yen fuel that's inflated crypto like a balloon in a war zone. December 19th looms, with 98% odds on a 25 BPS hike to 0.75% per poly market. What follows? The breakdown phase, a potential vacuum descent, sucking prices down 30% like a black hole devouring light. Technical targets in sight, stop runs triggering like landmines, and the psychological grit to hold or fold. You, the battle-hardened retail warrior, this is your playbook. Because while the crash feels inevitable, history shows these moves birth historic rebounds. Let's map the endgame. Envision the post-hike chaos. Yen surges, carry trades implode like a coiled spring unloading. Bitcoin, already down 30% from 126K highs, enters freefall. Technicals scream downside. Support at 85K breaks, next stop 70K, a 20–30% plunge from current 86K levels, aligning with historical patterns from Yahoo and TradingView. Below that, 65K, the concrete floor where March 2024 lows held. It's a stop-run paradise. Whales hunt retail stops like sharks in chummed waters, flushing longs before the reversal. Vacuum effect kicks in. Low liquidity over holidays amplifies moves, turning dips into craters. But explain it simply. Like a dam bursting, the unwind floods selling pressure, but once the water levels, the river stabilizes. Objections flood in, but skeptics say it's priced in. Markets know the hike's coming. Nah, front-running's already happening, but the real pain is the signal. If BOJ hints at more hikes into 2026, it's a multi-month black hole. Connect to megatrends. AI's data centers need energy, but tightening squeezes funding. Net zero transitions stall without liquidity. Tech giants like Nvidia feel the pinch, correlating with BTC at 42%. Who loses more? Over-leveraged retail. You chase the dip, get wrecked on volatility. Psychological advice. Treat it like a loading spring. Hold if your convictions steal. Bitcoin survived worse, from 2022's 70% crash to now. DCA smart, not emotional. Trim alts, stack sats during the vacuum. This Japan move? It's historic, inevitable. A paradigm shift from endless liquidity to disciplined capital. But here's the motivational close. Bitcoin isn't dying. It's evolving. From Silk Road obscurity to nation-state asset, it thrives on adversity. You've got the edge now. While others panic, you position. This could be the dip that mints the next wave of whales. If this investigation armed you, smash subscribe, hit notifications. We're just getting started on the next mega trend. Until then, hold tight, trade smart. The samurai strike is coming, but so is the dawn.